Hello, everybody. So today I want to do a mini discussion of three stocks: On Running, Lululemon, and Nike. These are apparel plays. These are shoe plays. You'll see that they kind of both, they all make shoes and they all make apparel. So let's go ahead and get started with Lululemon. So Lululemon, and the reason why I talk about that is because on X, I see a lot of people talk about Lululemon. I see a lot of people talk about Nike, and they show you the technical analysis and be like, "Oh, look, this is a great stock. Blah blah blah. These are wonderful." I actually like On Holdings the best. Surprise, out of all of these, because when I look at Lululemon, or when we'll get to Nike, Nike actually has negative growth. I only put 1% in there because I'm nice and I need to calculate an EV over GP over RG. But Nike actually is predicted to have their sales drop next year. But anyways, Lululemon, the growth rate next 12 months is predicted to be only 6%. That compared to On Running, which I'll get to in a second, which is predicted to still grow at 31% growth rates. So let's talk about Lululemon. Lululemon pretty much is not growing fast at all. It's so slow. If you look at store revenue growth, only 3%. If you look at digital revenue growth, only 9%. And of course, they have a product that is supposedly very trendy, right? All of social media is filled with women wearing these leggings. It's like a very trendy product, and you're only growing at 9% online. If I look at the apparel revenue, product innovation, same 5%. Accessories have everything like their shoes, for example. That's growing at 15%, but we're nowhere near my minimum threshold of 30% that I want to see in a stock. And if I look at market expansion, international is doing well, and by that we understand China is doing well. China is actually doing well, but the company, in my view, is not really doing well. And again, my reading of the social trends in my little fancy part of town here, and when I look at the stores and stuff, my reading is that Alo is taking a lot of business from Lululemon. That would be my reading of having a social life, and I see Alo in a lot of places, and I see a lot of people wearing Alo, and I'm afraid that the segment for pants between $100 and $130 for a pair of pants, I'm afraid that segment is being taken over by Alo, and you also have a few other ones. You have Athleta, you have Fabletics. I'm really concerned that this is being taken over by these brands. And perhaps what I'm even more concerned is the big amount of influencers online who are selling their own products or trying to sell their own products through Shein, of course, the Chinese platform, but also Shopify and Amazon, and they're frankly steals online. So I just took a random. I did not cherry pick. I did not pick the cheapest. This was in the first line that came up when I tapped a no-show high waist legging for women. It's $559 free shipping. If you go to the Lululemon website, a product which quite frankly is the same to me, looks the same, $108. And that's a sale price, by the way. These are for both of these stores. These are for Black Friday prices. So you're talking about a product that is, 22 times, 20 times more expensive. Let's say it, 20 times more expensive. And I'm afraid the customer's not biting anymore in the US as much as it used to. I'm afraid the young female consumer nowadays, they want to drop $130 on Alo, and not necessarily on Lululemon. And if they don't care, maybe they drop $5 on Amazon and they get a product that does the job. So this is my concern. And even though I understand that a lot of people are pointing out that the technical analysis on this stock is stunning, the fundamental analysis, to me, I wouldn't get behind this one fundamentally. To me, this doesn't pass my fundamental test. It was down 55% in a year, and it seems to me like it is warranted if we don't see a turnaround in those sales, and if Lululemon doesn't become trendy again. We've had many brands who have lost trendiness. You may remember Crocs, for example. I know some people in the market are still talking about Crocs. Crocs used to be trendy. It stopped being trendy. The business kind of, not died, but it's not doing well. So I'm afraid a little bit for Lululemon, and I would not necessarily touch it at this point. Now, let's talk about a stock that I like, which is On running shoes. I think On running shoes, and I will put Oka in there as well. But Oka, you gotta buy a bigger company, like to get exposure to Oka. Oka is part of this bigger conglomerate company. So unfortunately, you can't have pure play Oka. And that'd be interesting if you could, but you can't. On holding though, you can have pure play exposure to super expensive tennis shoes, which I think they go for on average something like $179 or something like that. For the record, I did go see on Amazon or on eBay, like what if you want to have like a pair of Adidas right now or a pair of Nike, and they are, like for the base models, they are between $30 and $40, quote unquote, on sale, quotation mark, right? But they're kind of always on sale. So the branded equivalent at Adidas or Nike would be between 30 and 40, at least in the United States. I know in Europe shoes are more expensive. Apparel is more expensive over there anyways. But this goes for I think 179 or something. Some of them are cheaper. It depends on the model. And you can see, of course, surprise, surprise, Oka, On Holdings, just like Lululemon, they released their yoga pants and their yoga sets. So you can see you have a random seller on Amazon that has it, and then you have Alo that has it, and then you have Lululemon that has it, and then you have On that has it, and then every single brand has their own. So where's the moat in making yoga pants for Lululemon, essentially? Is there a moat? I don't really know. If brands the moat, seems pretty weak. Seems to me like Alo is taking the spotlight. So anyways, On, I don't have that feeling at all. In fact, On, once you've seen that logo, you can't unsee it. You can't unsee it. You go to the airport, take the plane, whatever, you see that logo, it's a pretty trendy logo. Like I think, like a lot of men in there, between 35 and 50, a lot of men just buy these shoes for some reason. It's become kind of a very trendy thing, even a status symbol. Again, I don't really know. I don't own this brand. I own inexpensive shoes, but I'm just saying this is interesting. I think it's working out. I think On Holdings is working out. Another thing that On Holdings has figured out, which, for example, Nike has had issues figuring out, is that I think On Holdings is something like 70% direct to consumers and company-owned stores. And like the rest is their little retail network or little shoe sellers networks, etc. But I know they have a very high proportion of DTC sales, direct-to-consumer sales, and they sell a lot of those online. If you do that, if you sell online, if you sell a bunch on your own without a distribution channel, you have much higher margins. And in fact, On Holdings, despite investing in their growth, keep in mind this is a business growing at 31% next 12 months. So they, that EBITDA margin at 14% is reduced by capex, is reduced by marketing expense, right? Is reduced by sales expenses, right? But they still achieve 14% while investing in that revenue growth number. You can see Lululemon is earning 27%. Now, granted, if you sell a $5 item for $108, that's a very, very, very high margin. Well, actually, the gross margin is not that good either, 59%. I don't know. I don't know. I don't know if it's that big of a difference in quality or not. I honestly don't know too much. I don't want to look too much under the hood. When I look at the numbers, On looks pretty darn good. Lululemon, I would be worried, but we have to be honest, I wouldn't be as worried about Lululemon as I am about Nike or Nike. I know some people say Nike, but I always say Nike. So Nike. Okay. So of course, Nike, everybody knows Nike, world famous, like the 90s was very big for Nike. They were the main brand in the 90s, and they had a lot of inertia, lots of money, charismatic founder back in the day, etc., etc., etc. He had a tattoo of Nike on his foot or something. It's a storied company, there is no doubt, and it's a former hero, and it's been a hero for a long time. In fact, this company has been paying a dividend for 35 years, but they are on the verge of being a dividend aristocrat. This is year 23. Give them 18 months, they'll be a dividend aristocrat. And you know there's a lot of dividend investors who love that stuff. So they look at Nike and they're like, okay, this is amazing. They've raised the dividend for 23 years, and they're about to be a dividend aristocrat. But if you look at the stock price itself, it has been nothing short of a catastrophe. In late 2021, it was trading at $177. We are now at $64. 64. So that to me has been a destroyer of capital. That's point number one. And what concerns me a lot about Nike is the direction of their revenue growth. So like I said, down 1.44% is what analysts expect going forward. A drop in sales. That's not good when one of the hottest brands in shoes, and I'm sure Hoka has the same numbers, that's not good when these brands put 31% growth. That's not very good, 1%, minus 1% in sales. I put 1% in there because I want to calculate my EV over GP over RG, but that looks so ugly at a 5.02, right? It's 10 times more expensive for each percentage point of growth. It's 10 times more expensive than Lululemon. Lululemon looks cheap in comparison, but Lululemon is actually slightly expensive for my spreadsheet. For my spreadsheet, the clear winner is On Holdings on a growth-adjusted basis. I actually don't understand. If you just look at forward revenue, I mean, On Holdings is barely trading at 25% more on a enterprise value to forward revenue. There's only a 33% premium. It's not understandable. Like this should be at 10 if you apply any logic to this, but it's not. So for some reason the market has sold off On. I don't understand because they are growing very fast. Anyways. Here's what would concern me, because adjusted EBITDA growth is negative, and of course EBITDA is a proxy for cash flow. You can see it dropped minus 41% adjusted EBITDA over the past 12 months, and it's predicted to contract by another 10%. EBITDA is predicted to drop by another 10%. Why does this concern me? Because the payout ratio that they got is 82%. 82% payout ratio. Now think about if they increase the dividend, and then let's say they have a little bad year, next 12 months are not as good as they thought, and they end up having something like a 20% EBITDA margin ratio. Well, you could be a situation where they either stop increasing the dividend or where, even worse, they cut the dividend. And that is very awful for a stock, a dividend stock. Whenever a dividend stock experiences a dividend cut, the stock gets halved overnight. The stock can get halved overnight if they cut the dividend. And so that would be uncomfortably high for me. And I also want to finish on this. So you have Nike versus On Holdings versus Oka. Let's put it this way. To simplify, I'm greatly overly simplifying, but if you look at that revenue, 46 billion in revenue, that's huge, right? But Oka has been growing at 30% a year for quite a while. Now, I'm a little exaggerating here, so you feel free to use lower number. Let's assume they grow 30% for another 7 years or 6 years. Let's put it roughly 6 or 7 years, right? Let's assume they grow at the same pace for 6 years. Well, if they do that, that would be half of the revenue of Nike. And so if Hoka has the same performance, you could see a lot of the revenue that Nike is earning going to companies like On or Hoka. And if you look at the performance of revenue growth of On, it has been so steady. Like that, their revenue growth has been so steady. There's not a bump. There's no issue. Like it's just been growing so steadily, smoothly, beautifully. Between I guess over the past year and a half, it was between 20 and 40%. If you averaged out, we've been at 30% like that for years, and that's not accounting for, say, growth in sales due to the Olympics, right? That's also something that happens. Sporting events, you have the World Cup coming up. yeah, I guess they don't use this type of shoes, but sport becomes an interest whenever you have international events. And so, anyways, I wouldn't count them out. I think they can keep growing their revenue. So to me, On is the best apparel play out of all three of them, given that they are even launching their yoga pants. And it's tough to imagine having too big of a moat on these things. But anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.